A second gold rush, the yen carry trade and the race to win 2026. Flint West reporting. Right now, the S&P 500 is winning 2026, and by a comfortable margin. As of August 14th, using our comparative trading view baseline, the S&P is up roughly 12.6%. Gold, barely positive, about 1%. Bitcoin, down nearly 28%. And the prediction markets have looked at that scoreboard and basically called the race. 70% probability that the S&P finishes the year on top. Maybe they're right. But here's the problem. There are still 4.5 months left on the clock. And when you actually run the numbers, the S&P's lead isn't nearly as comfortable as it looks, because gold doesn't need to go parabolic, and the S&P doesn't need to crash. If the S&P falls about 10% from here, almost its entire year-to-date advantage disappears. That's it, 10%. Not 2008, not COVID, not the end of the financial system, a correction. And on the other side of the ledger, gold is sitting around $4,392 an ounce. Another 15% takes it to roughly $5,050. We've already been there. And if gold gets back there and holds it, we're talking about roughly 16% for the year. The S&P could literally go sideways from here and lose. That's the setup. But then comes the obvious question. What knocks the S&P off the perch? Initially, I thought the answer might be the Federal Reserve. Maybe Warsh hikes rates. Maybe he tightens financial conditions. Maybe the objective is to take some heat out of an equity market that's been running hard and encourage capital back toward government bonds. Possible. But there's a problem with that story. If the Fed raises rates, money doesn't have to run into gold. It can sit in cash. It can buy treasury bills. It can collect yield and wait. So a Fed hike might shake the tree, but it doesn't tell us where the fruit lands. Which brings us to something much more interesting. The yen carry trade. For years, Japan supplied the world with extraordinarily cheap money. Borrow yen cheaply. Convert it. Take that capital somewhere else. Buy something that pays more. Bonds, equities, technology stocks, whatever. Beautiful trade until the yen starts moving against you. Because if Japanese rates rise and the yen strengthens, suddenly that cheap funding isn't so cheap anymore. The trade starts going backwards. And when leverage goes backwards, investors don't sit around a conference table discussing their long-term asset allocation strategy. They sell. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. We've already seen the movie. August 2024, the yen surged. Carry trades started unwinding. The Nikkei collapsed. Global equities were hit. Technology stocks were hit. Leverage came out of the system fast. And here we are, August 2026. Again, except now Japan has a genuine domestic problem. The yen is weak, imports are expensive, inflation pressure is real, and the Bank of Japan has legitimate reasons to tighten monetary policy. That's the important part. The Bank of Japan doesn't have to be trying to crash Wall Street. It doesn't have to be trying to start a second gold rush. It doesn't even have to care about our thesis. Japan simply has to act in Japan's interests. And that's where this gets dangerous, because the yen has spent years functioning as part of the funding architecture underneath global risk-taking. So Japan can make a perfectly rational domestic decision and produce a completely unintended global consequence. A stronger yen compresses the carry trade. The carry trade compresses leverage. Leverage comes out, assets get sold. And suddenly that comfortable S&P lead starts disappearing. But here's where we have to be disciplined. A yen carry unwind does not automatically mean gold goes up. In the first phase of a genuine liquidation, gold might get sold too. Bitcoin certainly might. When the margin clerk calls, nobody cares about your 20-year monetary thesis. They want cash. So the first event is deleveraging. The second event is allocation, and those are not the same thing. After the forced selling stops, capital has to make another decision. Where do I go now? Cash? Treasury bills? Japanese government bonds? 10-year treasuries? 30-year treasuries? Back into equities? Bitcoin? Or gold? And this is where the second gold rush becomes interesting. Because gold doesn't need the yen carry trade to make its case. Central banks are already buying. Fiscal deficits are already enormous. Geopolitical uncertainty already exists. Sovereign debt concerns already exist. Currency debasement concerns already exist. And analysts are already contemplating gold at $5,000 and beyond. Even the SPY to gold ratio has begun rolling over. That doesn't prove people are selling stocks and buying gold. But it does tell us something very simple. Gold has started gaining ground. So maybe we've been asking the wrong question. Maybe the yen carry trade doesn't have to cause the second gold rush. Maybe these are two completely independent processes. One attacks the leader, the other strengthens the challenger. And if they happen to collide between now and December 31st, the whole scoreboard can flip. That's the thesis. No conspiracy required. No secret agreement between Washington and Tokyo. No central banker sitting behind a desk deciding that gold should hit $5,000. Just incentives. Just leverage. Just mathematics. Japan acts to protect Japan. The carry trade responds. Wall Street responds to the carry trade. And capital decides for itself where safety actually lives. Bitcoin sits in the background as our control variable. If gold runs and Bitcoin doesn't, perhaps we're watching a genuine monetary safe haven trade. If Bitcoin eventually joins it, perhaps the market is telling us something broader about scarce monetary assets themselves. We'll find out. The finishing line is December 31st, 2026, and the S&P is still in front. But the race isn't over. The yen carry trade doesn't have to create the second gold rush. It merely has to remove the S&P 500's lead. Gold can do the rest. Flint West signing off.